Good morning. Welcome, Your Excellencies, former Mr. President Goodluck Jonathan, Governor Obiano, His Royal Highness Igwe of Nnewi, honorable delegates, distinguished ladies and gentlemen. I would like to start by thanking the organizers of this conference for inviting me. 2 years ago, when Professor Ufodike informed me that he was planning this conference, I did the polite thing and offered to help out. I acted as a sounding board in some of the logistics and even escorted my father to Anambra State Governor's office to drop off an invitation letter. If only I had known back then that I would be roped into delivering a talk, I would have been more clever in avoiding myself the responsibility. That said, it's an honor to be here. I'm sorry I can't be with you in person. I'm in London, but I'm delivering this via video. I'm also delighted that this platform gives me the opportunity to talk about one of my favorite subjects, money and equitable wealth creation. Specifically, I'll be talking through some of the financing opportunities that exist which can address aquaculture infrastructure bottlenecks in order to unlock value. But before we begin, let me satisfy the scientific nature of this conference by reiterating known facts and figures. Nigeria, with a diminished year-on-year GDP growth of 2.8% in 2015, still has the largest economy and population in Africa at approximately 560 billion US dollars and 187 million people respectively. Agriculture's contribution to Nigeria's GDP is growing, and as a result of some of the structural challenges that were addressed in the last administration's agricultural transformation agenda. With 853 kilometers of coastline and 149,919 kilometers squared of inland waters, which are made up of major lakes, rivers, ponds, floodplains, mining, and stagnant pools, Ita et al., 1985, its potential yield presents a great opportunity. So Nigeria has the potential to lead the continent by harnessing its fisheries to satisfy both local consumption and regional trade. Currently, we are a net importer of over 3 million tons of fish. That's over 85% of our local consumption. Perhaps we're trying to copy America, where up to 90% of seafood consumed in the United States is imported. However, the main difference there is that a significant portion of America's imported seafood is caught in America by American fishermen, exported overseas for processing, and then re-imported to the United States. It is akin to Nigeria being a major exporter of crude oil with a dependence on imported refined petroleum products. So we still make money from oil, they still make money from fish. My call to action is for us to make fish Nigeria's new oil, but this time with greater local value add. How can we achieve this? The rest of my keynotes will propose ideas. I shall do this in two parts: innovation and sources of funding. Research, the foundation of innovation, supports the creation of high-growth businesses. In the latest edition of the Journal of Aquatic Sciences, by the way, my father has not paid me to say this, but I did note quality research publications, such as the hematological responses of the African catfish exposed to sublethal concentrations of an oil field wastewater in Nigeria, the gastrointestinal helminth parasites of fish species in Kwa Ibo River, Akwa Ibom State, Nigeria, and the seasonality and size distribution of the grey mullet in a tropical lagoon, southwest Nigeria, to name but a few. These world-class research papers produced locally are examples of what Planet Earth Institute describes as Africa's march towards scientific independence. It is vital that we continue to study in detail all the moving parts within our environment in order to understand the key triggers. With that knowledge, we can increase our productivity and yield while we decrease our impact on the ecosystem. If we examine the fisheries value chain, it can be broken down into the following sections. 1. Farm inputs, that includes the breeding, genetics, infrastructure. 2. Cultivation, that's rearing conditions and feed. 3, production, which is the harvest, primary processing and storage. 4, sales and marketing, that involves the packaging, pricing, and information around that. 5, distribution, so that's more about the logistics and delivery to the retailers, to the wholesalers, to the consumers. If you think about it, each stage within this value chain presents with distinct challenges and opportunities. Furthermore, different species of fish can have different pressure points, different requirements and bottlenecks along its value chain. For instance, challenges in the first 2 phases, the farm inputs and cultivation, can be mitigated by your research. We have sufficient information to know which combination of breed, feed, and rearing conditions provide optimum results. The implementation costs might be prohibitive. As we say, better soup na money kill lamb. But if, for example, more businesses that manufacture fish feed are backed, economies of scale will bring these costs down. With respect to the production phase, Dr. Babangida Kure, a researcher at Kingston University, London, sees room for multiple products in the small-scale fishery industry in Nigeria. He summarized that there is an opportunity to develop the industry given that Martins, 2013, discovered that extracted oil from species such as catfish can be used to develop other consumable products, including catfish cooking oil, pharmaceutical products, body cream, soap, and grease. Up-to-date pricing information sent via mobile alerts is an example of innovation taking place in the sales and marketing aspects of the value chain. Farmerline, a West African technology platform, does this today by sending SMS and voice messages on weather forecasts, market prices, new farming techniques, agrochemical applications, and finance directly to the mobile phones of farmers and fishermen in local languages. This vital information is not only a catalyst for greater operational efficiency, but in some cases is the lifeline that saves farmers from making decisions that could destroy their agribusiness. Distribution is a formidable bottleneck. As those of you that made it to Nnewi can attest, Nigeria's transportation network leaves a lot to be desired. In East Africa, unmanned aerial vehicles, also known as UAVs or drones, are already being used in the healthcare industry to deliver blood, essential vaccines, and other medical supplies to remote areas. These drones have payloads of up to 100 kilograms and travel dozens of kilometers. We can look forward to an era of drone airports as commonplace as petrol stations that serve as refueling and local distribution hubs. Think about the impact in the agricultural space. If we embrace technology and use it to leapfrog our infrastructure challenges, we can unlock domestic value. Africa, as a fragmented series of regional markets, has tremendous room for domestic brands and regional brands developing beyond borders. As scientists, I'm sure you appreciate that intellectual property, or IP, has transformational impact. Investors are also excited when a business proposition has high barriers to entry in the form of IP. Balancing how much IP you create before you focus on commercially exploiting your idea is key, and investors are ready to help. This brings me to my second point: sources of funding. Financing is a key pillar in industry, and it comes in various forms. Beyond grants and awards, the private sector have dedicated venture capital and private equity funds to focus on agricultural projects. Professional investors use debt, equity, a hybrid, or convertible instruments to gain exposure to your project. Whatever the investment, it comes with strings attached. For instance, with venture capital, shareholders give up a little equity and must grant investors access to company accounts. Sometimes a seat at the board is also required. The benefits, however, outweigh the sacrifice, as the smart capital not only provides the obvious cash flow required to keep the business as a going concern, but it supports management with building robust, scalable processes, opening new networks, granting access to capital markets in the future, and expanding into other regions These are things that a VC can do. To attract VC, entrepreneurs must have a compelling business case, strong management team, and operate in a high growth sector. Investors back tenacious, resourceful teams who will go that extra mile to succeed. To me, that sounds like the average Nigerian entrepreneur. In addition, Nigeria's macroeconomic factors suggest we are near the bottom of the cycle. And this translates to tailwinds for return on investments. Excuse me. Examples of Africa-focused investment houses that also keep an eye out for Nigerian agribusiness opportunities include the Databank AgriFund Manager Limited, as a DAFML, Helios Investment Partners, the Abroad Group, TPG Growth Africa, and 8 Miles. But there's several. The Nigerian government has also stepped in to support the financing gap. For instance, bank lending to agriculture has grown from 3.5 billion naira in 2012 to 25 billion naira in 2013. And reports from the Central Bank of Nigeria have shown that the default rate was 0%, which is an astounding record by any measure. This is a result of concerted efforts by the Ministry of Agriculture in collaboration with the Central Bank of Nigeria to launch the Nigerian Incentive-Based Risk Sharing for Agricultural Lending, otherwise known as NIRSAL, program, to reduce the risk of lending by banks to the agricultural sector. Over a dozen commercial banks are already lending to agriculture, and the trend is set to grow. In addition, a $100 million US fund for agricultural financing in Nigeria, FAFIN, was launched a couple of years ago for long-term tailored financing. The fund is capitalized by the Federal Ministry of Agriculture and Rural Development, the German Development Bank, KfW, and Nigeria Sovereign Wealth Fund, the NSIA. So these three have come together to capitalize that fund. Private sector project finance options also exist with strong local private equity houses such as SIVC, by Sahara Group, and Hares Holdings. One challenge of raising capital through most of the routes I've listed above is that you have to think big, because the money available from these investors is between 1 or 2 million US dollars and up to 200 million US dollars per allocation. So what is your company worth, and how much should you raise? The amount of equity given up is determined by the valuation of your company and how much risk capital is being placed by the investors. In the 7 years I've worked in venture capital, holding meetings with hundreds of startups, I am yet to meet a single entrepreneur who thinks a company is of a lower valuation than what an investor is willing to put into it. A simple way to begin this calculation is with a fair valuation estimation. So put your founder's bias aside, invite an objective accountant to review your books, your financial projections, and the assumptions that are underlying. Once you have this estimate, you can proceed to determine how much cash you need to survive for the next 18 to 24 months. This runway, as it's called, is how much investment capital you should raise. When you aim to raise that, what you give up is approximately your runway divided by your valuation. So, another fact worth remembering is that over 80% of startups fail within 2 years. Investors have to calculate what the risk is versus reward, and in most cases, the reward is factored into an exit strategy that they project for before they even commit on day one. What is an exit strategy? This is a credit event such as an initial public offering, an IPO, a trade sale, a management buyout, where new money is placed into a company, and at the same time, the older investors with shares are given the opportunity to liquidate their holdings in return for cash. Now, I hope you agree that there's a lot of money floating around to invest in your ideas. your big ideas. All you have to do is decide how much you want for your project and then go for it. In conclusion, raising capital is not a challenge unique to fisheries. Every business sector struggles when the wells run dry, pardon the pun. From the book How Asia Works by Joe Studwell, I noted the author's success formula for sustained high growth in countries such as China, Japan, and South Korea. These are A. Create conditions for small farmers to thrive. B. Use the proceeds from agricultural surpluses to build a manufacturing base that's focused on exports. And C. Nurture both these sectors with financial institutions working closely with and supported by the government. Nigeria is on the right track. Governance, research, private investments, and its desire to succeed are reaching an all-time high. But we cannot afford to slow down. We must push for better standards, for better terms, for better research and better governance. Why should we push ourselves more? I will answer that question with a quote I first heard from the Right Honourable Lord Paul Boateng, a former British High Commissioner to South Africa, and he's the current trustee of Planet Earth Institute. He says, and I agree, that only the best is good enough for Africa. After all, the shared goal is food security and alleviating some of the challenges the average Nigerian citizen faces on a daily basis. Thank you for your attention.